32 coins. That is all it took. Out of 840,000 Bitcoin, the man sold 32. And the entire crypto market lost its mind. Billions wiped out, liquidations cascading, prices collapsing from $67,000 to $65,000 to $63,000 in days. And the worst part? This was not some random whale dumping on retail. This was the man who looked America in the eye and said, "I will never sell, ever." He built a religion around those two words. Millions believed him. Regular people put their savings into Bitcoin because of his conviction. And then quietly, through an SEC filing most people never read, he sold. So today, I want to show you exactly what is happening to Bitcoin right now. Because this is not just about 32 coins. There are 3 separate forces destroying the price simultaneously. And one of them might actually be the most bullish thing Bitcoin has ever seen. Stay with me. Let me take you back to how this whole thing started. Michael Saylor did not accidentally become Bitcoin's biggest believer. He made a calculated, public, all-in bet. He took his company, then known as MicroStrategy, now rebranded as Strategy, and turned it into a Bitcoin treasury machine. Every quarter, more Bitcoin. Every dip, more buying. Every interview, the same message. Never sell. Hold forever. Bitcoin is the future. And for a while, that conviction looked like genius. Bitcoin went from under $10,000 to nearly $70,000. His company's stock exploded. He became a legend in the crypto world. People tattooed Bitcoin logos on their arms because of the movement he helped build. I remember watching his interviews thinking, this man has completely removed the exit from his mental model. He does not think about selling, because in his framework, selling Bitcoin is the same as burning your future. That was the message. That was the gospel. So when the SEC Form 8K dropped on June 1st, 2026, showing that Strategy had sold 32 Bitcoin between May 26th and May 31st for approximately $2.5 million at an average price of $77,135 per coin, the reaction online was immediate and visceral. People were furious, confused, betrayed. The comments flooding X were brutal. Things like, MicroStrategy preached hold forever and just quietly sold. Institutions built the hold forever religion and then walked out the back door. The market panicked not because of the amount, but because of what it meant. Bitcoin trades on belief, and once that belief cracked, even slightly, the price followed. Now here is the part most people completely missed. Saylor actually telegraphed this move months earlier. On the Q1 2026 earnings call, he said, "We will probably sell some Bitcoin to pay a dividend just to inoculate the market." He framed it as a strategic financial decision to support their STRC preferred shareholders. Those preferred shares carry roughly an 11.5% annualized variable dividend, and the company needed cash to fund those payouts. So was this a betrayal or just business? Honestly, both things can be true at the same time. It can be a completely rational financial decision and still feel like a gut punch to millions of retail investors who built their entire Bitcoin thesis around this one man's conviction. That is the part Wall Street never fully understands about crypto. It is not just money, it is belief. And when the high priest of never sell quietly files an SEC document showing he sold, belief breaks. And when belief breaks in crypto, the price does not walk down, it falls. But here is the truth. Saylor selling 32 Bitcoin out of 840,000 is not actually why Bitcoin is crashing. That was the match. The fire was already burning underneath, and it had been burning for over 10 straight days before anyone was really paying attention. Let me show you what was actually happening. For more than 10 consecutive days leading into June 2026, U.S. spot Bitcoin ETFs recorded net outflows, day after day after day, money leaving, not trickling out, pouring out. Over $3 billion pulled from Bitcoin ETF products in a matter of weeks. On some individual days, the outflows crossed $500 million in a single 24-hour window. Think about what that actually means. When the Bitcoin ETFs launched in early 2024, the entire crypto world celebrated. Finally, institutional money flowing in. Finally, mainstream validation. Finally, the moment Bitcoin had been waiting for. And for a while, it worked exactly like that. The price surged, the narrative held. It felt like a new era.
But here is what retail investors did not fully absorb about institutional money. Institutions are not emotional holders. They do not believe in Bitcoin the way Saylor believes in Bitcoin. They do not have diamond hands. They have risk models. And when those models say reduce exposure, they reduce exposure. No hesitation, no loyalty, no religion. And right now, their models are screaming reduce exposure because the macro environment is genuinely ugly. US-Iran tensions are back in the headlines. Energy prices are climbing. And here is the thing that really twists the knife. The stock market is at all-time highs. The S&P 500 is setting records. AI stocks are on fire. And Bitcoin is bleeding out.
That decoupling is deeply uncomfortable for anyone who believed Bitcoin was the ultimate store of value, the ultimate safe haven. Because right now, money is leaving crypto and rotating straight into tech and AI and traditional equities. And when that institutional money exits the ETFs, it creates a vacuum. And into that vacuum rushed the liquidations. $1.2 billion to $1.8 billion in crypto liquidations in single 24-hour periods. The majority of those were long positions. People who leveraged up, betting Bitcoin was going higher and got completely wiped out when it went lower. Leverage cuts both ways. Right now, it is cutting through the market like a blade.
So you have three separate pressure points hitting Bitcoin at the exact same time. Saylor's sale shattering the psychological narrative that had held for years. ETF outflows removing the institutional buying pressure that had been propping up the price. And a macro environment actively pulling money away from crypto and toward AI and tech. That is not bad luck. That is a perfect storm. But here is where this story takes a turn that most people are completely sleeping on. Because while all of this chaos is happening on the surface, something historic is quietly being built underneath. The United States government is building a strategic Bitcoin reserve. Treasury Secretary Scott Bessent confirmed recently that the reserve is moving forward with, and this is his exact framing, all deliberate speed. He connected digital assets directly to national and economic security. His words were, economic security is national security, and digital assets are part of that strategy. Let that actually land for a second. The same government that spent years treating crypto like a problem to be regulated is now treating Bitcoin like a strategic national asset. The same Treasury Department that made crypto founders nervous is now talking about Bitcoin in the same sentence as national security.
The reserve started with seized Bitcoin, assets confiscated from criminal prosecutions, dark web operations, and exchange hacks. Estimates put the initial holdings somewhere between $15 and $20 billion worth of Bitcoin at the time of establishment. But the conversations happening in Congress right now, through bills like the Bitcoin Act, are about structured future purchases. The government going into the open market and buying Bitcoin over time as a deliberate national strategy. That is not a bearish signal. That is one of the most structurally bullish things that has ever happened to any asset class in modern financial history.
And this is where the current moment becomes genuinely disorienting for retail investors, because everything is happening simultaneously. Short term, the price is getting destroyed. Long term, the fundamental case for Bitcoin just became stronger than it has ever been. Now, Let me tell you where I personally got this wrong in the past, because I think this is actually the most valuable part of this conversation. The first time I watched a major Bitcoin conviction holder sell after years of preaching never sell, I panicked. I read it as the signal that the smart money was leaving. I sold my position. And then I watched Bitcoin recover and had to buy back in at prices higher than where I sold. That mistake cost me real money and months of stress and second guessing.
The second mistake I made was treating institutional behavior like retail behavior, seeing ETF outflows and assuming institutions were done with Bitcoin forever. They are not. They never are. Institutions reduce exposure when the short-term risk model says so, and they come back when the entry improves. That is literally how they operate. What those two mistakes taught me is this: the question that matters is never who sold this week. The question that matters is whether the long-term structural case for the asset is still intact. And right now, with a government reserve being built, with legislative clarity advancing in Congress, with institutional infrastructure already in place, the structural case for Bitcoin is arguably stronger today than it was at any previous price peak.
The price is down. The story is not. So where does this actually leave us? Benjamin Cowen, one of the most data-driven Bitcoin cycle analysts out there, pointed out that the current price action matches past midterm year patterns almost precisely. June lows in 2018, June lows in 2022, potentially June lows again in 2026. His read is a near-term bottom forming this month, a possible recovery rally in July, with a final low potentially in October before the next major leg higher. Arthur Hayes, the BitMEX co-founder, started taking profits on some altcoin positions this week. His reasoning involves rising energy prices, AI IPO momentum pulling capital, and his expectation of a market inflection point somewhere around September. He is not calling for a Bitcoin collapse. He is managing risk the way professionals manage risk, which is something retail investors almost never do until it is too late. And the broader analyst consensus for the next 6 to 12 months? If Bitcoin holds the $60,000 to $62,000 support zone, the targets being discussed range from $80,000 to $90,000 on the conservative end, and $100,000 to $150,000 by late 2026 if historical cycle patterns hold.
Here is what I keep coming back to, though. The people who are panic selling at $63,000 because Michael Saylor sold 32 coins, those are the same people who will be asking 6 months from now why they missed the next rally. I have watched this pattern play out multiple times. The emotion is real, the fear is real, but the decision it produces is almost always wrong. Michael Saylor selling 32 Bitcoin out of 840,000 to fund a preferred dividend is not the end of Bitcoin. It is a company making a routine financial decision. Symbolically uncomfortable, yes. Fundamentally world-ending, absolutely not. The ETF outflows will reverse when the macro picture shifts. The liquidations have already cleared out a massive amount of over-leveraged positions, which is actually healthy for the next move up. And the government reserve is not going away. If anything, it is accelerating. I am not here to tell you what to do with your money. I am not a financial advisor. This is not financial advice. But I will tell you what the data is showing, what the analysts are saying, and what history suggests about moments exactly like this one. $60,000 is the line. If that holds, this is accumulation territory. If that breaks, we reassess. But the idea that Bitcoin is finished because the man who built the never sell religion sold 32 coins out of nearly 1 million? That is fear talking, not logic. The religion did not die. It just got tested. And in Bitcoin, every test has eventually made the believers stronger and the doubters quieter. That pattern is held through every crash, every panic, every headline, and every moment exactly like this one. The question is never whether Bitcoin survives the test. The question is always, will you?